Can a company, one that was basically a pandemic sensation, can it really transform its whole business model? Or is it, destined to just be a one-hit wonder? That's really the big question we're tackling today as we dive into Novavax. It's trading around $6.49 as of June 27th, 2025, and honestly, it's one of the most debated stocks out there right now. Welcome to the deep dive. This is where we take, well, a whole stack of information and try to distill it down into the most important nuggets for you.
Yeah, today we're really digging into Novavax Inc.
Hmm.
It's a biotech company that's, well, it's been on a roller coaster, hasn't it? A truly tumultuous journey. And our sources for this deep dive, they come from a really comprehensive fundamental analysis report on NVAX. Gives us a detailed look at their business, their financials, their market position, everything. Our mission here is pretty simple: help you understand the core arguments, both for and against this company, cut through the noise, get to what actually matters for, your own thinking.
Absolutely. And before we really unpack all of that, just a quick reminder, please do like and subscribe to the Stock Analytics AI YouTube channel. It's just €4.99 a month, and members get priority deep dives on the tickers they request. Plus, over the next few months, we're covering all of the S&P 500 stocks, and members get first dibs. And hey, if you just want a one-off deep dive on a specific company, just drop us a super thanks. Okay, let's get started. Chapter 1, Business Analysis. So this company, Novavax, it's been around for decades, right? Had this explosive moment during the pandemic, and now they say they're undergoing a significant strategic transformation. What does this pivot, this move to a partnership-focused R&D model actually mean for them on the ground?
Well, fundamentally, it's about de-risking. They're trying to spread the risk out. Their new model is built on three key revenue streams. First, you've got product sales. That's mainly their COVID-19 vaccine, Nuvaxovid. Now, you might remember seeing their Q1 2025 revenue. It looked, well, surprisingly high, like $667 million. But, and this is crucial, nearly $603 million of that was a one-time accounting thing. It came from terminating old purchase agreements.
I mean, that single accounting event nearly matched their entire revenue for the whole of 2024. Just goes to show you the volatility, right? And how much of the stream isn't really recurring.
That's a huge point. So not sustainable core revenue. But, okay, here's where it gets really interesting. You mentioned partnerships. Licensing, royalties, and other revenue. This sounds like the strategic heart of their future. They're partnering up with big pharma players like Sanofi, who'll take over commercializing the COVID vaccine and even explore new combination vaccines. So this means what? Big upfront payments for Novavax, milestone payments, royalties. Exactly. That's the plan. Large upfront cash, payments tied to hitting specific targets like approvals, and then long-term royalties based on Sanofi sales. That's the second stream. And the third stream is supply sales. This is where they make money from their proprietary Matrix-M adjuvant and other vaccine components. Key customers here are folks like the Serum Institute of India, SK Bioscience, and Takeda.
Okay, so beyond just the COVID vaccine product, what's their core value? What makes Novavax stand out, assuming they can execute this?
It really comes down to their technology platform. I mean, yeah, the flagship product is Nuvaxovid, their recombinant protein-based COVID-19 vaccine. And its key position is being the only non-mRNA COVID-19 vaccine available in the U.S. It offers a more, let's say, traditional vaccine technology. And importantly, it got full FDA BLA approval, that's the biologics license application, in May 2025 for certain groups. That's a big regulatory hurdle cleared.
Okay, BLA approval is significant. But you mentioned the adjuvant earlier, the Matrix-M adjuvant. You said this might be even more important long-term. What's so special about it?
Look, this is arguably their crown jewel, their most valuable long-term asset. An adjuvant, boosts the immune response to a vaccine. Matrix-M comes from the soap bark tree. It makes vaccines more potent, the immunity lasts longer, and critically, it's antigen-sparing.
Antigen sparing. So you need less of the main vaccine ingredient.
Exactly. That means you can potentially make more doses faster, or use smaller doses, which has huge implications for cost and manufacturing. And Novavax isn't just using it themselves. They're actively licensing Matrix-M out for use in a whole range of other vaccines, even in oncology, cancer vaccines. That creates a whole separate, potentially very lucrative revenue stream.
Wow. Okay. So future growth isn't just COVID 2.0. It's this adjuvant platform and their R&D pipeline.
Precisely. Their future really hinges on that pipeline. The candidate that's furthest along is a COVID-19 influenza combination CIC vaccine. It's in phase 3 trials right now. If that works out, it could be massive.
So you put all this together, where does Novavax actually stand in the big picture, in the global pharma world?
Well, they're still a niche player. Market cap around, what, $1.05 billion? That's peanuts compared to giants like Pfizer or Merck. Remember, their brief period of scale during the pandemic was largely bankrolled by that huge $1.6 billion award from Operation Warp Speed.
Right.
Without that, well, it's a different story. So their core value proposition now is this differentiated, clinically proven vaccine tech, serving as the traditional alternative to mRNA, appealing to a specific slice of the market.
Okay, and what about the broader vaccine market they're playing in? Is it growing?
Oh, yeah, the global vaccine market is solid, projected to grow at almost 6% CAGR, from about $2.3 billion this year, 2025, to over $4 billion by 2035. Key trends are things like more focus on adult shots, combination vaccines like their CIC, and just rapid tech advancement. AI is even playing a role now.
And competition must be fierce.
It's intense. You've got the established giants, plus those nimble biotechs like Moderna and BioNTech that really surged with mRNA. Novavax isn't trying to match their scale. They're competing by offering something different, that protein subunit vaccine technology.
Yeah.
Which brings us inevitably to the regulatory side of things. You can't talk vaccines without talking regulation.
No, absolutely. The hurdles are massive. The FDA here in the U.S., other agencies globally, the frameworks are incredibly strict. It's years and years of clinical trials, phase 1, 2, 3, proving safety, proving efficacy, before you can even submit that BLA we mentioned.
So let's talk about the cost. The barriers to entry are just formidable. Developing a vaccine can cost anywhere from $500 million to over $1 billion. Navigating the trials and the FDA, it's monumental.
You know, the story of Novavax itself is almost a perfect case study here, isn't it? They struggled for decades, faced near delisting after those RSV trial failures in 2016, 2019. They only really broke through because of that unprecedented government funding during the pandemic.
Exactly. That history really underscores why their new strategy is about partnerships. They learned the hard way that trying to go it alone against those barriers is incredibly risky. Partnering makes a lot more sense.
Okay, so given that, let's talk competitive advantage. What's Novavax's moat, if they have one? What protects them?
Right, the moat. It isn't sheer size, obviously. It's more a collection of unique things. While Nuvaxovid isn't a household name like Pfizer's vaccine, it has carved out a distinct brand as the main non-mRNA option that appeals to people specifically looking for an alternative.
What about cost advantages? You mentioned distribution earlier.
Yeah, that's a big one, potentially. Logistics. Their Nuvaxovid vaccine is stable in a regular fridge, 2 degrees C to 8 degrees C. Think back to the early mRNA rollout, the ultra-cold freezers, the complex cold chain. Nuvaxovid avoids all that. That simplifies distribution, especially globally, and reduces spoilage. It's a real practical advantage. Sure. And then there are the network effects and switching costs they're trying to build, mainly through that Sanofi partnership. Sanofi is investing time and money co-developing those combo vaccines, marketing Nuvaxovid. That creates pretty high switching costs for Sanofi. It helps lock in Novavax's position, makes it harder for Sanofi to just swap them out.
And the core, truly unique assets.
That has to be their proprietary and clinically validated technology platform. That recombinant nanoparticle tech, combined with the patented Matrix M adjuvant, that combination is hard to replicate, it's protected, and it really underpins their entire value proposition. The shift from focusing just on the product to leveraging the whole platform, that's the key change for thinking about their long-term value.
Okay, that sets the stage for the business. Now let's shift gears to the people driving this. Chapter 2, management evaluation. How important is the leadership team in this turnaround story?
Hugely important. And you really have to distinguish between the leadership before 2023 and the team that's in place now. The previous leadership, well, they oversaw that really rough period. Remember those late-stage clinical trial failures for their RSV vaccine?
Right.
2016, then again in 2019? That just decimated the stock. They were close to being delisted.
Right. That was brutal. So what changed? Who came in?
January 2023, John C. Jacobs takes over as a CEO. He's got serious industry chops, came from Teva, YF, Pfizer, Harmony Biosciences. He actually led an IPO at Harmony. And he walked right into a crisis at Novavax, bloated costs left over for the pandemic boom, revenue falling off a cliff. It led to that scary going concern warning in their filings, basically auditors saying, we're not sure this company can survive. His response was immediate. Big restructuring, deep cost cuts, and that aggressive pivot to the partnership model we've been talking about.
And the board did that change too.
Yep, the refresh went right up to the board. Margaret McGlenn, who used to be president of Merck Vaccine's very relevant experience, became chair in March 2025. Dr. John Shiver joined as an independent director, too. So the new team's expertise seems much better aligned with this new partnership-focused strategy.
What about transparency? How open have they been about the challenges?
Well, the current team seems committed to being upfront. I mean, they publicly acknowledged that Going concern risk back in the 2022-2023 filings, that takes some guts. And if you connect this to the bigger picture, their whole philosophy on capital allocation has shifted. It's night and day. The new mantra is disciplined and capital-efficient R&D. They're making, quote, smart, lower-cost bets on early-stage pipeline programs. The goal is to get proof of concept, show something works, then bring in partners like Sanofi to fund the really expensive late-stage trials. It basically outsources a huge chunk of the financial risk.
Interesting. Any significant M&A mergers and acquisitions in their history besides bringing in Matrix M?
Not a lot, but what they've done is impactful. That 2013 deal for Iskanova AB was absolutely critical for getting Matrix M. And more recently, remember they sold a manufacturing plant in the Czech Republic to Novo Nordisk. That brought in $200 million cash, shorted the balance sheet, and cut their overhead significantly. Smart move.
Okay. And dividends or share buybacks? I think I know the answer.
Yeah. Typical for a developing biotech. No history of dividends, no share repurchases. All the cash goes back into R&D or just keeping the lights on. Which raises an important question, though. What about the return on invested capital, ROIC? What kind of returns are they actually generating on the money they invest?
Historically, terrible, deeply negative ROIC for years, reflecting all that capital they burned through without getting products to market successfully. Now, Q1 2025 technically produced a positive ROIC, but like the revenue number, it's highly misleading. It's purely because of that big non-cash accounting gain. So any meaningful analysis of ROIC has to look forward. The whole investment case basically rests on whether this new partnership model can finally generate positive returns in the future. They need to get somewhere near the biotech industry median, which is around 19-20%. That's the goal. All right, let's dive deeper into the numbers. Chapter 3, financial analysis. What is the balance sheet, the income statement, the cash flow? What do they tell us?
Okay, financials. As of late June 2025, their market capitalization is hovering around $1.05 billion. Like we said, small cap biotech territory. They're just dwarfed by the competition.
And revenue growth trends. You mentioned volatility.
Exceptionally volatile, is putting it mildly. It was almost entirely driven by the pandemic surge and then collapse. Revenue exploded, peaked near $2 billion in 2022, then plummeted. And again, that Q1 2025 number, $667 million.
Yeah.
Looks amazing until you remember $603 million of it was that one-time recognition from terminated deals. Highly misleading if you're trying to spot a trend.
Okay, same story with profit margins, I assume?
Exactly the same story, erratic, historically negative, deep losses in 2023 and 2024. Then, boom, Q1 2025 shows this anomalous net profit margin of 77.8%. But again, that extraordinary figure is not representative of the actual business operations, and it's certainly not sustainable. This brings up a really critical metric, especially for value investors. Free cash flow, FCF. This tells you how much cash the actual operations are generating after investments. What does that look like?
Yeah, FCF paints a much more sober picture. It has been consistently and significantly negative. Even with that huge reported net income in Q1 2025, their free cash flow for that same quarter was actually a negative $186.72 million. That stark difference really shows you, doesn't it? The Q1 profit was an accounting gain on paper, while the core business was still burning through cash.
That table in our sources showing the numbers from 2020 through Q1 25, it just highlights that extreme volatility across revenue, gross profit, net income. It makes forecasting their future incredibly difficult based on past performance.
So zero earnings consistency then?
Absolutely none. Prolonged losses, that brief pandemic sugar high, back to losses, and then this one weird profitable quarter driven by accounting. And here's something fascinating and frankly concerning. Their debt-to-equity ratio. As of the end of March 2025, their total liabilities, what they owe, were $1.37 billion. Their total assets were only $1.29 billion. That results in negative shareholder equity of about negative $76 million. On paper, on a book value basis, that means they're technically insolvent. Their debts outweigh their assets. That's a major red flag for more conservative investors.
Wow, okay, so that sounds pretty grim financially.
Well, yes and no. The long-term solvency picture is worrying, for sure, but paradoxically, their short-term liquidity has actually improved quite a bit. Their current ratio, which measures if they can pay their bills coming due in the next year, is actually at a healthy 2.06. That's a big improvement.
And that's thanks
largely to the upfront cash they got from that Sanofi deal, plus a settlement they reached with Gavi, the vaccine alliance. So it looks like they have enough liquid assets to keep operating for the next year or so.
Okay. And still no dividends on the horizon?
Nope. No history, not expected. So this leads us to the million-dollar question, or maybe the billion-dollar question here. How on earth do you value this company?
Right. If you look at relative valuation, comparing it to peers, Well, their trailing PE ratio, price to earnings, is around 2.1 to 2.4, but honestly, that number is dangerously misleading. Any serious analyst should completely disregard it. It's artificially low only because of that massive one-time Q1 income boost. A forward price to sales, PS ratio, might be slightly more useful. Based on their raised 2025 revenue guidance, it's around 1.05x. Sales are less easily distorted by one-off accounting things. That gives you a slightly more reasonable comparison point.
Okay, so relative valuation is tricky. What about intrinsic valuation? Trying to figure out what the company itself is actually worth based on future cash flows. That usually means a discounted cash flow or DCF analysis.
Exactly. A DCF is the most appropriate tool here, trying to value the company based on its future ability to generate cash. But it's heavily dependent on assumptions. So what are the key assumptions for a Novavax DCF model?
Well, you'd have to model out probability-weighted revenues. You'd factor in those Sanofi milestone payments like the $175 million they expect upon final U.S. BLA approval for the combo vaccine work. You'd estimate royalty streams. You'd have to make assumptions about the probability of success and potential revenue from that CIC vaccine. Add in some modest revenue from Matrix M licensing deals. And crucially, given the high-risk nature of this company, you need to use a high discount rate, probably somewhere in the 12% to 15% range, maybe even higher, to reflect that uncertainty. And then a conservative long-term terminal growth rate, maybe 2.5%.
Okay, so running those kinds of numbers through an educational DCF model,
Now,
what sort of value range does that spit out?
as you'd expect, it generates a really wide range.
Mhm.
It perfectly reflects that high-risk, high-reward profile. A reasonable base case scenario might yield an intrinsic value around $11 per share. That assumes Sanofi delivers, the CIC vaccine is moderately successful, things like that. But a bull case scenario, if royalties are higher, CIC is a huge hit, they sign multiple big Matrix M deals, you could maybe justify something closer to $22 per share. Then again, the bear case scenario is grim. Sanofi deal falters, CIC fails, they have to raise more cash by selling shares, diluting existing shareholders. That could result in a value below the current price, maybe around $4 per share.
So the analysis points to a central estimate, maybe $11, which is above the current $6.49 price. But that huge range, $4 to $22, it just screams uncertainty and high sensitivity to execution. Okay, let's move on to Chapter 4, Market Sentiment. What's the general feeling, the vibe around Novavax in the market right now?
Well, like we hinted at, the professional analyst community is deeply split. It's a classic battleground stock. There's no consensus. The official consensus rating is actually a hold, but that often just means analysts are uncertain. They don't have strong conviction either way, buy or sell.
And that fracture is really obvious in the price targets, right? It's kind of wild. You've got Citigroup with a $6 sell rating on one end, and then other analysts projecting $26 or even seeing potential up to $35.12. That massive disagreement tells you just how differently people are viewing this turnaround story.
Exactly. And the recent news flow reflects that division too. You get bullish news, those strong Q1 financials, even with the caveat, the FDA BLA approval, positive data snippets on the CIC vaccine, the huge Sanofi partnership. But then you get the bearish counterpoints. Citi sell rating, constant reminders about the intense competition, dredging up their past execution problems. It's push and pull.
What about market indicators, things beyond analyst reports?
Well, one of the most telling indicators for Novavax right now is its exceptionally high short interest. Short interest, remember, is the percentage of shares being borrowed and sold by investors, betting the price will go down. For Novavax, shares sold short are somewhere between 32.5% and nearly 33% of the total float, the shares available for trading.
Wow, a third of the float.
Yeah, it's huge, more than double the average for similar companies. It means a very significant chunk of the market is actively betting against the stock. Now, this creates downward pressure, but it also creates the potential for extreme volatility, like a short squeeze, if unexpectedly good news hits and forces those short sellers to buy back shares quickly, driving the price up rapidly.
Okay, high short interest signals skepticism. What about the technical picture? Where's the price relative to its moving averages?
As of late June 2025, the share price, around $6.49, is trading below its 50-day moving average, which is about $6.73. That suggests a bearish trend in the short to medium term, and the long-term trend looks even worse. The price is significantly below its 200-day moving average, which sits up around $8.60. So the technical picture confirms that negative momentum. Investing at the current price would mean going against a pretty strong established downtrend.
Okay, let's shift perspective again. Chapter 5, ownership structure. Who actually owns Novavax stock?
Well, institutional ownership is pretty substantial. Somewhere between, say, 47% and 67% of the outstanding shares are held by big institutions, mutual funds, pension funds, etc. But it's quite concentrated. A few large players hold big chunks. Vanguard Group has nearly 10%. BlackRock has about 8%.
And what's fascinating here, isn't there an activist investor involved? Yeah, Shaw Capital Management, they're an activist fund, and they're the third largest shareholder with about 6.9%. Novavax has actually publicly mentioned their constructive engagement and alignment with Shaw on the turnaround plan. That adds an interesting dynamic, maybe some external pressure for results, but also validation. And crucially, their big strategic partner, Sanofi, holds about 4.3% of the stock now, too. That definitely helps align interests.
Right. But in stark contrast to that institutional and partner ownership, direct insider holdings are very low. Management and the board collectively own only about 1% of the company. For some investors, that low skin in the game is a concern. They like to see management heavily invested alongside shareholders. And recent insider transactions, mostly just routine stuff related to stock options or compensation, not significant open market buying, which would be a stronger signal of confidence.
Okay, makes sense. Now for probably the most crucial chapter for potential investors, Chapter 6, Risk Assessment. Let's break this down using a SWOT analysis. Strengths, weaknesses, opportunities, threats. First up, strengths. What are Novavax's core internal competencies? What do they do well?
Their main strength has to be that differentiated and proven technology platform, the recombinant protein approach combined with the unique Matrix M adjuvant. It's clinically validated, it works. The major strategic partnership with Sanofi is another huge strength now. It provides external validation, critical non-dilutive funding, and access to Sanofi's global commercial machine. That significantly de-risks the execution side. Achieving full regulatory approval, the BLA, for Nuvaxovid provides a solid base. And we mentioned the improved short-term liquidity from the Sanofi cash and asset sales that gives them breathing room and operational runway. Okay, but that brings up the flip side. What are their internal limitations, your weaknesses?
Well, the new model itself creates a big weakness. Heavy partner dependency, particularly on Sanofi. If that relationship sours or Sanofi deprioritizes the program, Novavax is in deep trouble. That negative shareholder equity we talked about, technical insolvency on a book basis. That's a major financial weakness, a red flag. Despite the Q1 accounting profit, they still have ongoing operational cash burn. Getting to sustainable positive free cash flow is still a future challenge, not a current reality. And you can't ignore their history of execution challenges. The past manufacturing scale-up problems, the previous clinical trial failures, that track record still hangs over them in investors' minds.
All right, weakness is acknowledged. Now, what about the opportunities? Where could they find future growth or market potential?
The biggest one might be to really monetize the Matrix M adjuvant as a standalone product. Licensing it out widely, including for cancer vaccines, like you mentioned, could create a really valuable high-margin revenue stream separate from their own vaccine products. Then there's pipeline advancement. Success with that COVID-influenza combination, CIC vaccine in phase 3, that's potentially a blockbuster opportunity right there. And they can continue addressing vaccine hesitancy. By being the main non-mRNA option, they appeal to a specific segment, and that market might persist.
Okay, strengths, weaknesses, opportunities.
Yeah.
Now for the external threats, general external. What challenges are coming from outside the company?
Well, number one is just the intensely competitive market. They're up against behemoths with vastly deeper pockets and established infrastructure. There's also ongoing uncertainty in the COVID-19 market. How big will the endemic market be? How often will boosters be needed? It's still unclear, and that directly impacts Nuvaxovid demand. And we have to mention the extreme market skepticism reflected in that massive short interest. It creates constant downward pressure on the stock price and feeds volatility. And of course, inherent in biotech, there's always clinical and regulatory risk. Trials can fail, regulators can ask for more data.
Right. And if we connect this to the bigger picture, how do macroeconomic factors play in?
Birth-
Threats, macroeconomic factors.
Inflation is a big one. It increases their costs for R&D, manufacturing, everything, squeezing margins. Plus, things like the U.S. Inflation Reduction Act, IRA, bring in government price negotiations for drugs eventually, creating long-term pricing pressure. Interest rates are another key threat. When rates are high, it's much harder and more expensive for companies like Novavax, which are burning cash, to raise new capital if they need it. It becomes a real race against time to get profitable before the cash runs out or borrowing becomes too costly.
And finally, any specific geopolitical threats we should consider?
Yes, there's a potentially significant one on the horizon. New U.S. imposed tariffs possibly coming in 2025. These could range from 10% to 25% on active pharmaceutical ingredients, APIs, the core drug components, and other manufacturing inputs coming from places like China, India, or even Europe. Novavax relies on a global supply chain, so tariffs like that would directly hit their cost of goods sold, making their products more expensive to produce, and could disrupt their logistics too. It's another layer of external risk.
Okay, we've covered a lot of ground. We've reached Chapter 7, conclusion. So let's try to synthesize all these findings. What's the big picture for Novavax?
Novavax is, truly at a crossroads. It perfectly embodies that classic high-risk, high-reward investment profile. It's a quintessential battleground stock. You have two incredibly compelling stories here, but they point in completely opposite directions.
Okay, let's lay them out. First, the bull case. What are the core arguments for a positive outlook? Why might this stock be a buy? The bull case is all about believing in the fundamental and strategic transformation led by the new, experienced management team. They argue Novavax has a differentiated, validated technology platform, and that Matrix-M adjuvant is a significant, maybe underappreciated asset with broad licensing potential. They'll say the new model is significantly de-risked by the Sanofi partnership, which shifts a lot of the clinical development and commercialization risk and cost onto Sanofi. Bulls see a credible pathway to profitability now, with a leaner cost structure and the improved balance sheet from recent deals. And finally, they'll point to the depressed valuation relative to potential future earnings, if things go right, and that high short interest, arguing that if Novavax delivers, the upside could be explosive due to a potential short squeeze.
Okay, that's the bull case. Now, the bear case. Why might investors bet against Novavax or sell the stock?
The bear case is anchored firmly in their history of value destruction. Just look at the long-term stock chart and that negative shareholder equity. They haven't delivered consistent value. Bears emphasize the extreme financial fragility. Yes, liquidity is better short-term, but they are still burning cash from core operations. Profitability is not guaranteed. They highlight the over-reliance on a single partnership with Sanofi. If anything goes wrong there, delays, disagreements, strategic shifts at Sanofi, it could be catastrophic for Novavax. And bears stress the intense competition and market uncertainty, especially for the COVID-19 vaccine in an endemic market. Can Nuvaxovid maintain meaningful share? Finally, the bearish technical indicators and that incredibly high short interest aren't just noise. They reflect a deep and widespread market conviction that this turnaround attempt will ultimately fail, just like previous attempts.
So bringing it back to the valuation summary, what's the bottom line there?
The bottom line is that the intrinsic valuation is extremely sensitive to which future you believe in. Our educational DCF model points to a base case intrinsic value around $11 per share. That assumes reasonable success with Sanofi and the CIC vaccine. But the range is huge, maybe as low as $4 per share in a bear case, maybe as high as $22 per share in a very optimistic bull case.
Okay, so as of June 27, 2025, Novavax trades at $6.49. Our base case analysis suggests an intrinsic value significantly higher, maybe around $11, indicating potential undervaluation at the current price.
Yes, but that comes with a massive caveat. That enormous gap between the bull and bear case scenarios highlights the extreme level of risk and uncertainty involved here. The future value of this stock is almost entirely dependent on whether this new management team can flawlessly execute this new partnership-driven strategy and finally achieve sustainable profitability. The market's deep skepticism, shown by that short interest, simply cannot be ignored.
So the takeaway is, while Novavax might appear undervalued based on a base case scenario, this stock is really suitable only for investors with a very high tolerance for risk, a long-term view, and strong conviction in this specific management team and the potential of their unique technology platform, especially Matrix-M. It's definitely not for the faint of heart.
Wow, what a deep dive into Novavax. It's really clear, isn't it? This isn't just about one company's stock. It's a fascinating look at the high-stakes game of biotech innovation, the challenges of strategic pivots, and how market sentiment can create these intense battlegrounds.
It really is. And it leaves you wondering, doesn't it? Could this platform-centric strategy, leveraging a unique asset like Matrix-M through partnerships, could that actually be a viable blueprint for other smaller biotechs facing similar make-or-break challenges in this tough environment? Something to think about. Absolutely. We hope this deep dive gave you some serious food for thought. And please don't forget to like this video and subscribe to the Stock Analytics AI YouTube channel for more deep dives just like this one. Remember, members get priority access to our S&P 500 coverage and can request specific tickers. And a super thanks gets you a one-off deep dive.
And as always, please remember, this analysis was generated by an AI system. It's for educational and informational purposes only and should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.